that's why I'm here every day working. I'm just saying right now the market's going lower. It could be 30%, it could be 50%, it could be 60%, 70%. I just don't know. But it's headed lower, and it's going to continue going lower until we get a genuine Fed pivot and or the inflation rate comes down to a point less than 4% on the headline CPI that allows Powell to stop hiking interest rates.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. A year ago, when today's expert appeared on this channel, he warned of an approaching bear market and economic deceleration. Specifically, he predicted these would be caused by the simultaneous shutoff of the trillions of dollars worth of government stimulus issued in the year following the global pandemic. This would be the largest monetary and fiscal cliffs in history, he warned. Well, fast forward to today, and well, his outlook was right on the money. So what does he see in store as we head into next year? To find out, we're fortunate to welcome macro analyst and money manager Michael Pento back to the program. Michael, thanks so much for joining us today.
It's always a pleasure to be on with you, Adam. And I know you're too humble to say this yourself, but your channel has become the place for financial news and information. And it's because of you. And it's a privilege to be on with you. So thank you. I mean,
well, thank you, and I'm blushing here, Michael, because one, it's a life highlight to get a compliment like that from somebody who I hold in such esteem as you. But I think a big reason this channel has had the success it's had because we've had great people like Michael Pento willing to come on the program here. All right, so we've probably churned everybody's stomach with our saccharine, male love fest here. But it is very true. Thank you so much, and I appreciate the compliment, but I also appreciate you being a part of this whole experience as well. All right, look, let's jump right into the story. Now that you've built me up so much, I'm probably going to disappoint everybody here. But let's start with the question that I always start with. I know we just had a big event last night in the country. We just had an election. We're still waiting for the final results to come in. And if any of your answers are influenced by the outcome of last night, let's just weave that in as we discuss here. Sure. Michael, what is your current assessment of the global economy and financial markets?
Well, first of all, the recession inertia is now unstoppable. Even if we had a genuine Powell pivot right now, or he was to pause hiking interest rates, forget about even a genuine pivot. The recession inertia is unstoppable, and we can go through all the evidence of that a little bit later on in the interview. But Wall Street was like a sycophant begging Powell to pivot, and he did indeed pivot in his last press conference. But he pivoted to be more hawkish instead of dovish. So what he said was that we might instead do 2 25 basis point rate hikes in one, not 3. That might be down the road, but the ending point, the plateau point, is going to be close to 5%. So it is going to be higher than he thought it was going to be in September. And he said, when we get there, forget about what the Fed futures curve is doing. We are not going to immediately cut rates back to 0%. We're going to stay at 5% for a very long time, for many months. So what we have is a very steep recession brewing. The first 2 quarters of 2022 were negative, Q3 slightly positive, and we can get into why I think that was mostly BS. I hope you ask me about that. If you don't, I'll mention to you why.
All right, I will.
Ephemeral and temporary. And we have the fattest, into that recession, we have the fastest rate of change. So interest rates on the overnight interbank lending rate are going from 0% in March of this year, we were still at 0, all the way to 5% in March. And quantitative tightening has just ramped up. It started in September. We're just now cutting about 90 to 95 billion a month off of the balance sheet. So that's the environment we are in now. And yet we still have the equity market at a higher price to earnings ratio, higher price to sales ratio, and a higher total market cap to GDP ratio than any other time prior to 2020. That's how expensive stocks still are. So that's your environment, and that's why I'm still bearish. Yes, I am very bearish. I think we have a 30% drop from here, unless and until we have a genuine Powell pivot, which takes interest rates back to zero, which goes back into QE, and or we get CPI below 4%. You're not going to get either of those things probably until Q2 2023.
Okay, lots in there. Great answer. You gave me lots of threads to pull on. Let me pull on the last one first. So, is it fair to say, looking through your lens, that you see us in the span of maybe a year or so, maybe if we start counting from early this year, maybe a little bit more than a year, having dialed through all of the inflations, inflation to stagflation to disinflation to deflation, right? So we had inflation, growing through 2021 into this year. I think we can make a pretty good case we're in stagflation right now. We've still got very high CPI. Economic growth is very anemic. You just said that you expect CPI to come down to the 4%-ish range over the next couple of quarters. That is classic disinflation. Do we even tip into deflation at some point?
So inflation is very a subjective term, and people define it as rising prices, inflating the M2 money supply, M3 money supply, Fed's balance sheet. Inflation in reality is when the market loses faith in a currency's purchasing power. So what we have now is deflation in some aspects of the market and economy. I mean, let's look at Bitcoin, which is actually falling out of bed. Deflation there. Okay, deflation in Bitcoin. Deflation in equity prices. We're about to have deflation in real estate prices. We've had deflation in bond prices, but we have disinflation in CPI, the Consumer Price Index. So we have deflation on Wall Street and in asset prices, disinflation in CPI. I think CPI could disinflate, hopefully, towards 4% by the second quarter, sometime in the second quarter of next year, just because base effects here, because of the asset bubble implosion that we're going through, because of no fiscal stimulus. When you want to weave in the election, okay, Wall Street is never bereaved of a narrative to get you bullish. Seasonality, it's a good seasonality to buy stocks. Oh, it's the midterm elections. Well, I think we had midterm elections in 2018, and that didn't bode too well for stocks. So They always come up with these narratives. Well, now the narrative is, hey, we're going to have gridlock in DC. Well, wonderful. Gridlock is great in the long term. I'm all for it. I'm a libertarian. I'm not a Democrat or a Republican. But you're going to need, in order to attenuate and truncate this recession, you're going to need some massive fiscal and monetary support. You're not going to get any monetary support. You're not going to get any TARP program. You're not going to get any helicopter money passed. So you're going to have no help. You're only going to have the automatic stabilizers that kick in during any recession. That's not going to be enough to turn this thing around very quickly. You're going to need, as I said, massive fiscal and monetary support. It's just not coming.
Right. So it sounds like gridlock not going to get on the fiscal side. And if we are to take Jerome Powell at his word, he is saying no monetary, white knight riding to the rescue here anytime soon as well. All right. So let me ask you a couple of pointed questions. I would say one of the areas of debate on this channel of late is experts who have said, and some of the recent guys mentioning this are smart guys, Jim Grant, Bill Fleckenstein, a few others who have said, I think inflation's going to prove harder for the Fed to get under control. It's creeping into services. That's 2/3 of consumer spending. It's harder to get it out of there. Once you've raised people's wages, it's hard to get it down again. And they think it's going to be a more protracted problem for the Fed. And their worry is that the Fed, pauses or pivots too soon, and that reignites inflation, right? Then you have people on the other side. I'd put like David Rosenberg, again, others very smart people, Jim Rickards, Stephanie Pomboy, who say, the forces of deflation that are, pulling down on economic growth right now are so strong that they are going to win out. And we have precedent for that. When you look back in 08, the speed with which the CPI went from like above 5 to 0 happened very quickly. And you just mentioned yourself, you think that there's a big recession ahead, as well as maybe perhaps a 30% more decline in the markets. So I guess my question is do you fall clearly on either side of that debate?
Well, yes. So inflation isn't something that happens when a genie comes out of a bottle. It's not natural. I call it the gravitational forces of deflation are at play here. And primarily they're asset price implosions. So stock, bond, and real estate price implosions. So inflation comes from massive fiscal and monetary helicopter, we'll call it helicopter money. When a central bank monetizes government debt. And that's exactly what we did. We passed $6 trillion of stimuli. 4.5 trillion of that was monetized by the Fed. And it didn't just go to Wall Street. So again, we have two types of deflation, not cost push, demand pull. That's true on some extent too. But there's also two types of manifestations of inflation. Inflation that manifests on Wall Street, like we had from 2008 all the way to 2020.
Right. So asset price inflation. Yeah.
Right. And then you have inflation, CPI inflation, which manifested from 2020 on because we circumnavigated the banking system. We said, hey, I know how to get inflation going. And Powell even gave a nod to this in his press conference. We know how to get inflation. It's not a mystery. We don't just, give banks credit, Fed credit, right? High-powered money and say, here, give us your treasuries, give us your mortgage-backed securities and go buy more. Go buy more treasuries, more MBS and stocks. We didn't do that. We said, here public, here Main Street, here's your check. Go out and consume something and we'll just directly monetize it. That causes CPI inflation. So, but that's gone. That's over with. That's over and done with. So we talked about the monetary impetus. That's going to be deflationary. And even on the fiscal side, there's still trickles of fiscal stimulus, but nothing like we had. And inflation is a year-over-year comparison. All right. So we're going to have disinflation and deflation going forward, not inflation, because again, it's not a genie. It has to come from an impulse, and the fiscal and monetary impulses are not there any longer.
Okay. And this again is what I want to really give you your props for, Michael. As I said in the intro, back in 2021, you were ringing the warning bell about the deflationary aspects of this massive monetary and fiscal cliff. In fact, you were one of the very first people I heard really speaking loudly about this. And so I do want to give you your proper kudos for sticking your neck out when it wasn't necessarily common knowledge at that point in time, and then now being proved correct. So on that point, there are a number of people who have said, and many are still saying, yeah, Powell can say whatever he wants to say, but interest rates at this level are so high that it's going to break something, and that Powell is going to be forced to have to do an about face here, and yes, possibly pivot, not by choice. He can say whatever he wants up until this point, but something's going to happen where he gets frightened or pressured enough that he's going to have to reverse course and do the Powell pivot. So what are your thoughts on that? So it's clear that unless that happens, I know you're saying, look, Powell's not going to come to the rescue. Congress can't if it's gridlocked. But is there potential for something systemic to break badly enough that it actually forces a policy pivot here that's material in changing your outlook?
Yes, the answer is yes. So let's put some more meat on the bones there. So what could break? So if we have the junk bond market freeze, if commercial paper market freezes, if we see a spike in the repo market and we start tapping that standing repo facility, These are things that could cause Powell to pivot. And here's my thought process there. I can't get ahead of that now, because when those things happen, so let's just look at, the sequence here. First, the junk bond market freeze. You can't issue any more junk bonds. Then the commercial paper market freezes. And then there's problems in the money markets. Then the shadow banking systems start fail. Pension funds get in trouble because they own too much Bitcoin. Investment banks start failing. Then you'll get a genuine Powell pivot. But the time between then and now is an air pocket for stocks. And I don't want to be a part of that. Mm-hmm. So yes, there will be a genuine pivot, but the pivot's going to come too late to save stocks. That's when the pivot comes, I'll start covering my shorts. But not until then. That you can't, if the mindset is, well, Powell's going to pivot, and that's the mindset from most of Wall Street, well, Powell's going to have to pivot. Oh, yeah, I think he will, but he's going to be forced to pivot because the credit markets freeze. And the action of that happening is going to be very, very detrimental to all asset prices. That's the time you want to have already been short and covering your shorts, not thinking about getting short then if you have the ability to do so.
Got it. And I have had a couple other guests on this program that have echoed what I hear you're saying here, which is, there's a lot of people that are thinking, pivot means everything's green again and back off to the races. Some of these experts have said, no, the thing that actually may force the Fed to pivot may be so bad that everything is getting crushed in some vortex at that time. So you're going to want to wait for the dust to settle from that. You don't want to be positioned in front of that because you'll get drawn down with it.
Exactly. And you had a gentleman on your program, a former Fed official, said, I'm not worried about a recession. I'm not worried about a stock market decline because there's, automatic stabilizers and these standing facilities in place.
Right.
Facility. But think about how healthy is the market, especially the credit market's going to function, the money market's going to function when banks can't lend money to each other. They have to get their money from the Fed at a penalty rate. Yeah, I mean, that's an attenuating process, but it's not going to bode well for stocks if everybody knows that the credit markets have frozen and they're relying on the Fed to reliquefy the system. That's bad news in the short term for equities. That's all I'm saying.
Yeah. And okay, so you're going to wait to see several dominoes fall before you take any action on this, is what you're saying. Okay, so couple quick questions for you. So first off, some people doubt that Powell can even get to 5 or 5.25, which is sort of where he's guiding right now, right? They just think that something's going to break before then. I'm asking you just to kind of guess here. Do you think he can get there, or do you think the wheels start coming off sooner than that? Because, we have a much more indebted economy today than we did even just prior to the 2008 crisis. I think we have like 3.5 times more national debt, like 9 trillion versus 31 trillion now.
So, I mean, I'm here every day working, so I'm going to make a prognostication that the Fed can get to around 4.75. But things are breaking now. I don't think he can get to 5. And when he gets to 5, and again, I'm not contradicting myself, but when he gets to 5 and he says, I'm going to stay there, if he gets to 5 and he says, I'm going to stay there for a long time, I think, and I already put the meat on the bones, I think the credit markets start freezing. I think you can't issue any more junk bonds. I think you can't issue commercial paper. I think the shadow banking system breaks, and that causes him to say, oh, I can't stay at 5 forever or months or quarters on end. I have to start cutting rates and heading back to 0. In fact, shockingly, Adam, and this is shocking, in his press conference, the arrogance of this man is, he was buying mortgage-backed securities all the way up to like June this year.
Yeah.
And then he said,
and not a little, a lot, right? 60 billion a month or so?
A lot of mortgage-backed securities. Forget about treasuries, he's buying mortgage-backed securities, even though housing prices are going up 20% a year over year for several years. And then he says this, instead of some introspection and say, geez, maybe I should just think about what I'm doing and stop this, yo-yo economy. He actually said, after he said he's going higher for longer, he said, hey, but by the way, if I do end up breaking something, I'll just go back to what we did before. I'll go back to 0% interest rates in QE. This is why the 60-40 portfolio is dead. That's why this is the actual rationale behind the creation of the inflation deflation economic cycle model, because you're going to have periods of booms and busts, and being long bonds in an inflationary environment is deadly, but being long them in a bust cycle could be very beneficiary. So what asset classes do you want to own? What style factors, what sectors is crucially important, given the fact that the Fed has, their recidivism rate is 100%. They're going to just go back and do the same thing over and over again. I couldn't believe my ears. I mean, I was hoping he would have said, well, we can't go back to ZIRP. We can't go back to QE because we know that that's going to just engender inflation problem that we're going to have to raise interest rates even higher the next time. They didn't say that at all. So, yeah, it's a disaster.
Okay, and we are making our way to the how to allocate for all of this, but it sounds like, Michael, if I'm following you correctly, you think that Powell is going to try to do what he said he's going to do, hike to 5 and then hold for a long time. But it sounds like you're skeptical that he's going to be able to. Sounds like you think that something's going to break and he is going to have to change policy.
Correct. Credit markets, money markets freeze, and he has to change policy sooner than he thinks. I know he's like Nostradamus when it comes to markets and the economy, but he's going to be wrong again.
Yeah, well, and I think enough of our viewers have been watching long enough to know that the Fed's track record in terms of its predictions of what's going to happen is pretty abysmal. So why should we really expect it to change much at all here? Okay, so we've got the Fed hiking rates here. I'm trying to figure out which question to ask first. Let me ask this one first. In talking to a couple people who are close to the Fed, I did talk to Joseph Wang, who you mentioned earlier. He wasn't a Fed official, but he was a trader on the Fed's open markets desk, right? So he was one of the guys out there buying those mortgage-backed securities and stuff like that for the Fed. I also talked to Pedro da Costa, who's a journalist who has covered the Fed and other central banks for decades, for Wall Street Journal, Reuters, big publications like that. So he's talked to these guys daily forever. And he's of the opinion, and I think Joseph agreed with this, that QE as a stimulative policy tool may be getting retired. In other words, there'll still be emergency lending that happens, in a crisis, but the Fed has kind of woken up to the fact that it causes a lot of it doesn't repair the economy the way they're hoping it's going to, and it tends to it's really exacerbated the wealth inequality issue to levels where it's not very visible, and the Fed's quite worried about that. So where I'm going with this is, if something breaks, do you expect Powell to address it primarily by lowering rates versus QE, or do you expect, forget it, it's just back to the old playbook?
Well, the Fed doesn't just lower interest rates by decree, by fiat, the way they print money. They lower interest rates by printing money, which is a form of QE. QE just means when you get to zero, the zero bound, you don't stop there. You keep on expanding your balance sheet. But in order to get interest rates from 5% back towards 0%, the Fed has to print an awful lot of money and buy bonds and expand their balance sheet. So there really is just semantics here. If you're asking, will they go to zero and stop? I'm hoping that's the case. I don't see any evidence of that, because Powell said it himself. We know exactly how to get inflation going. So the action is the action. To lower interest rates, you have to go in there, create Fed credit, buy bonds in the overnight interbank lending market, and flood the system with money and bring down the cost of borrowing between banks. That's how it works. So that it's a distinction with not much of a difference. Okay.
So it sounds like you're saying, hey, we should expect the playbook that we've been used to.
Yep, that's what he said, and that's how they're going to get interest rates down. Whether they stop at zero or not, I don't know. I guess the answer to that would be, well, how liquid are the money markets at that point? If they're still not functioning properly, he's going to go into QE.
All right, Michael. Well, look, let me move on to two related topics. So one is interest rates, and one is the dollar. So interest rates have risen substantially, as you were saying earlier, and at the fastest pace that we've seen, like in the data set, right? And as we know, there's a delay between Fed policy and when that gets manifested in the economy. So one could make an argument, and Jim Rickards just made a very good one on this program last week, that like the Fed should stop right now, because if we are indeed tipping into a big recession next year, we're probably making it worse by continuing to hike from here, because we haven't even had the impact yet of most of the hikes, the full impact yet of most of the hikes that have been made in the past 6 to 8 months, because there's usually sort of an average like a 9-month delay, right? I guess first question is how concerned are you about the to be felt impacts of the rate hikes that have already been made in this story?
So I'm very concerned. Rate hikes come with about a 6 to 9 month lag, as you indicated. In March, we were still at 0. So September is when we first started feeling the rate hike pinch. And that was the same month we just started to ramp up quantitative tightening. So yeah, we're just in the outer bands of this hurricane. It's a Cat 5. So we have a long way to go. I was hoping you were going to ask me what I would do. I think you said you asked Jim Rickards what he would do.
Well, let me ask you, what would you do? I make you emperor for the day, or for the year. What do you do?
So first of all, if I couldn't get the entire Eccles building inhabitants to resign and go on welfare, if I couldn't convince them of that, I would ask Jerome Powell, Jerome, you have a very, very high inflation rate, historically speaking, right? So basically, if they calculate it correctly, it'd be a all-time high, but it's at least at a 40-year high. Jerome, why is your balance sheet still $100 billion higher than it was 1 year ago today? So, give rate hikes a break, give rate hikes a pause. But why are you not concentrating on your balance sheet? What's the rationale behind keeping your balance sheet so high for so long? Start selling stuff. Start selling mortgage-backed securities and treasuries. Get your balance sheet down and let the rate hikes just stay where they are. Say around, once we're around 4%. Bring in the 4, pause, and get your balance sheet under control. This way you get rid of some of the inflation on Wall Street, but don't kill Main Street as much as you're going to do. And I'd like to talk about how bad things already are getting, if you will let me, in the very near future.
Okay. Well, we're headed right there. My next bullet after this is about recession outlook. Real quick though, just to complete the macro context, the dollar. So the dollar has been a juggernaut this year, right? Mm-hmm. I mean, it's been unstoppable. It has basically been crushing all asset prices, and certainly just destroying international markets, right? Been crushing other currencies, been making the pain that's being felt elsewhere in the world a lot worse, especially for folks that are importing or have dollar-denominated debts. What do you see is happening from here with the dollar? Do we get a bit of a reduction, or do you see the dollar continuing to go further from here?
So in sector 1 of the inflation, deflation, economic cycle spectrum, you own dollars. It's the primary asset you hold is cash, dollars, bonds, and shorts. So dollars have been great for us for well over a year now. I think they have a little bit more room to go, but at the point of breaking something, at the point where this recession becomes fully manifest, you're going to get a top in the dollar. So we don't have much more room to go, maybe a few months, in my opinion. And then you're going to have to sell the dollar. I think we will top out.
Okay, great. And I want to dig a little bit more into that when we get to the portfolio allocation part of this discussion. But first, the topic you wanted to dive into. So this is sort of so how bad do we think it's going to get going into next year, Michael? And we got kind of 4 components here. We've got economic growth, or maybe economic contraction might be a better way to say it. We've got a potentially continuation of bear markets, a bear market in financial assets. We then have the housing market rollover, which you've already cited a couple of times. And I think in all the mix of that, we have to ask, okay, what's the layoff outlook? In other words, from a consumer, how they're going to feel and experience this, how bad is it going to get?
Okay, so first 2 quarters of this year were negative. We have a boost in Q3. I think it was 2.6%. That was boosted by a couple of things. Number 1, a huge inventory build in Q3. Number 2, Joe Biden was dumping 150 million barrels of oil to the highest bidder. Many of them were foreign corporations. So the net export number exploded.
Yeah.
And then but the Bureau of Economic Analysis undercounted inflation. They said inflation in Q3 was 4.1%. I don't think anybody believes that annualized inflation was 4.1%. So that's Q3. Q4.
Okay. So you're basically saying they had a generous deflator.
Very generous.
Number.
Well, the CPI was 8.1%, while they were, they undercounted it by half.
Yeah.
So a very generous GDP deflator. That's not going to be repeated in Q4. None of that stuff is going to be repeated. I don't think Joe Biden and the Democrats are going to be dumping 150 million barrels of oil to foreigners so they can boost net exports. I don't think that's going to happen. I don't think they're going to undercount inflation again. And the inventory build becomes an inventory unwind, which is actually a subtraction from GDP.
Yep.
But let's see how bad things are getting right now. First of all, Amazon, US's largest online retailer, warned of the slowest increase in holiday sales in the company's record. That's number one. Number two, mortgage applications. Now, let's look at the housing market now. This is a housing depression we're headed into. Mortgage applications were down year over year, 41%, Adam. You cannot tell me that the demand for mortgages, this is mortgage purchase applications, not refis. They were down well into the 80s. Purchase applications down 41%. Existing home sales year over year down 24%. That's the depression in housing. Homeowners lost $1.5 trillion in equity since May. Okay. Bloomberg did a study. 37% of small businesses, by the way, employ half of the workers in the United States. 37% of small businesses could not pay their rent, their last rent payment. This is just starting. Oh, by the way, one more thing. Everybody was excited about the non-farm payroll numbers still being, better than expected. CNBS loves to do that. The household survey showed a decline of 300,000. I think it was 306,000 to be precise, of workers out of the labor force, lost their job. So you have just that inkling of those outer bands starting to hit. I think that intensifies greatly. I think earnings drop 30. The average earnings drop in a recession is 30%. Just if we have an average recession, Adam. So you have earnings crater. The economy is going to hit a very big air pocket in Q4. Those earnings get reported in Q1. And I think after that, in Q2, you can have a chance to actually buy a sustainable rally in the market. But it's going to come from asset prices, especially equities, I think can drop 30% from here. And I'm going to just give you a couple of statistics here. Stocks as a percentage of the economy. They were at one point 210% of GDP. And as I said, we have the highest price at the start of 2022, the highest price to sales ratio in the history, even higher than the NASDAQ bubble in the year 2000, higher than the real estate bubble. So when you look at the total market cap of GDP, stocks don't bottom where they are now. They're now 150%, 145, 150% of GDP. They should be around 74% as they bottomed in the NASDAQ bubble. They bottomed out at 45%. Total market cap of equities, percentage of GDP, the best metric known to man as far as the valuation of equities. They bottomed out at 45% in 2009. We're at 146% TMC to GDP. So the valuation of stocks as compared to the underlying economy. And even in the Great Recession pandemic, Adam, stocks bottomed at 120% total market cap of equities to GDP. And by the way, when those things happened, when those bottoms occurred, the Fed was at 1% after the after the NASDAQ bubble burst. They were at 0% after the real estate market burst, and they were in QE and 0% interest rates in the pandemic and in the Great Recession. We're not anywhere close to that. So how could we possibly talk about a market bottoming when they're when stocks are 1.5 times the underlying economy. It's just way too early. And we have, as I said, I started this program, the most hawkish central bank since 1913. And they're doing that action into one of the steepest recessions we've ever had since 1980. Look at the yield curve. The yield curve now is inverted by 54 basis points. You have to go all the way back to 1981 to find the yield curve. 40 years, over 40 years. This yield curve inversion, the 10-2 spread, one of the indicators of my model, is screaming you're not just going to get an average run-of-the-mill recession. You're going to get a very, very protracted and acute recession.
Okay, so you just outlined a true parade of horribles, right? For all good reasons, all very data-driven. When you were on this program last time, Michael, which was, I don't know, 3-4 months ago or so, I think at the time you were saying you could see the markets, the stock markets, correcting by about 40%. I wrote down here, you just wrote, you could see earnings dropping by 30%. And I think you said maybe about a 30% drop in stocks. And I'm just curious, are you ratcheting it down to 30% now just because we're down, 20-ish% from the start of the year? We've already taken some of the froth out here.
No.
And maybe in your answer, you talked about how, depending upon which analog we use, if we wanted to use the 2008 analog, market cap to GDP went down to like 45% or something like that, which would be like a 2/3 or more drop from where we are right now. So I'm not trying to push you. I'm just trying to give you to rationalize sort of what you think is most likely.
So I think, the 30%, first of all, let's just start with, we don't know. We're just doing our best estimates at this point in time, this juncture. What we do know, what I know, is that the odds of the market going lower are extremely high, close to 100%. The odds of a very steep recession are, close to 100%.
Pretty darn good. Yeah.
So the calculation is the minimum decline is 30%, because that's just the number that brings us back to total market cap of equities to GDP at 100%. Now, I said 30% as a minimum. That's predicated on a couple of things. When does Powell pivot, a genuine pivot?
Right.
And what is the CPI doing at that juncture? So, and the two are very much related, because if CPI is still in the 7s and the market's down 30%, I mean, that ties his hands to a very big degree. Okay. So that's why I'm here every day working. I'm just saying right now the market's going lower. It could be 30%, it could be 50%, it could be 60%, 70%. I just don't know. But it's headed lower, and it's going to continue going lower until we get a genuine Fed pivot and or the inflation rate comes down to a point less than 4% on the headline CPI that allows Powell to stop hiking interest rates.
All right. Now to the key discussion here, the main event, which is, okay, you're in that office every day because this is an unfolding situation, and there are sort of, different playbooks that you may deploy depending upon what happens here, right? When does Powell look like Powell's going to pivot? What's inflation doing at that time? You're really going to have to keep a lot of things in mind. But in the here and now, you have to manage client capital. And first off, let me just ask, it's been a rough year, right, for all capital managers, because pretty much just about every asset has gone down, right? It's been one of the worst years on record for both stocks and bonds combined. How has your portfolio fared on a relative basis?
So this year
Our interview with Michael will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. And remember, we're continuing our new practice of publishing my top takeaways from these weekly interviews. To get mine from this interview with Michael for free, just go to wealthion.com/AdamsNotes. And finally, If the challenging macro outlook that Michael has detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Michael's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Michael Pento.